Hey guys, this is Corey. I'm one of the staff traders here at TopsetOptions.com, and today we want to show you a sample trade that we've done recently that illustrates the covered call trading method versus the bull call spread method. And so if you don't know about Thompson Options, we invite you to visit the site ThompsonOptions.com, where you can see a variety of things and ways that you can learn about options trading, generally from Michael Thompson. He's the master of the site. We have both free content as well as member content, in addition to multiple other things on the site. So we certainly invite you to visit the site. Again, I'm one of the staff traders, and if you want to learn about staff trades, you can go to the About Us page, where you'll get education by Michael Thompson as well as by the staff itself. So if you go to the staff picks page, you'll see what we focus on, the type of trades that we make, and how our trades differ from the master, and what the goal of it is. So Mike and I had a trade that we were doing on Home Depot where we wanted to compete versus each other. I prefer to do a lot of covered call trades. I find them very safe and manageable ways to make double-digit annual returns with minimal risk. Mike prefers a more aggressive approach, as you'll learn on the site. That's Michael S., not Michael Thompson. And so he chose to do a bull call spread. So you can see this trade was initially made on September 13th. And I chose to buy 500 shares of Home Depot at this particular price and then sell 5 covered calls against them. My net investment was $36,000, and my goal was to make 1% of that trade, or $365, within a week, which would give me a double-digit annual return with what I feel is minimal risk. Home Depot is a quality stock. The market was good at the time. There was little risk that it would go down, but if it did, I had downside protection. But if it went up, then I would make more on the value of the stock increase than I would lose on the short call. So that's the essence of the covered call swing trade. I've done it a number of times on this site, and every time it's proven to be successful. Mike has a different approach, and he chose to use a bull call spread, buying 10 November 75 calls. Remember, Home Depot at this time was 74.85. That's what it was trading at. And then he sold 4 October 77.5 calls. His total investment was only $2,000. His profit goal was to make 10%, or $210, again within a week. So that was the goals that we each had. The goal was to try to make a profitable return, as well as to generate a high annual return. And so at the time, the market went up, and let's see how the trade developed. We both met our profit goals on September 13th. In this particular case, I, again Corey, was able to sell my 500 shares for a profit. My calls also went up in value. Remember, it's a short call, so I ended up losing money on the short call, but my overall investment was positive because, again, the value of the stock, when it goes up, will generally go up higher than the loss on the short calls, and that's the whole purpose of the covered call swing trade. And so then ultimately I made $615, which was well more than my goal. Made it within a week. My hold period was 7 days. My annual return was 88%. I think that's pretty darn good. Mike, however, blew me away. His trade came in much higher. So because the stock went up, his calls went up dramatically. He bought them for $2,400. Sold them for $4,000. He lost money on the short calls because that was his downside protection, but he made over $1,100 off of a net investment of $2,000. So he made an overall profit of $1,153 in 7 days for an annual return of $2,800. So that's a comparison of a covered call swing trade versus a bull call spread. Now, if the market would always go up, then you would obviously just want to buy long calls or just do these bull call spreads. But the market always doesn't work out like that, obviously. And so it's up to you to figure out what's better. Had the market gone down, Mike's trade would ultimately, and had not recovered in time, because of the time value of options, as you know, Mike's trade would ultimately have been a losing proposition. Now, if the market went down, my trade also would have went down. I would have, though, sold my calls at a profit then, and overall the stock would have went down. But I still owned the stock. Time value does not hurt my stock like it would have with Mike's, and when the market recovered, I could have resold my stock for a gain, which is sometimes I do that quite frequently if the market does go down, or I could have sold additional covered calls or multiple other methods. So you have to decide what's best for you. If you always want to swing for home runs, go for the bull spreads. If you want more consistent returns, and for me, I just take 20% annual returns, but I'll take 88% every day of the week. But that's up to you to decide what is your investment risk tolerance. But this is an example, again, of a covered call swing trade versus a bull call spread. What's your opinion? Do you like this trade? Would you have done something different? Would you have held longer? You know, we discuss all of these things at Tomset Options, and we do give you the option to be a member where you get a chance to find out Michael Tomset's trade ideas. He publishes way more trade ideas than his staff does. Charts of the day, educational archives, a members forum, a newsletter. All of these things are included in the price of membership at Tomset Options. So if you're interested in learning more, again, please visit the site at tomsetoptions.com. Have a great day.